Milind Karmarkar, Director and Fund Manager at Dalal Broacha PMS, joins in. Milind, very good morning to you, and great as always to have you on NDTV Profit. Thank you so much for your time.
Good. Most welcome.
So how are you reading, and I will say emotions, actually. I know you're looking at the chart, screen and data, but right now what's happening in the market is also a lot about emotion. How are you reading the emotions on both ends? One which is saying doomsday and one which is only trying to look at the glass half full. Is the worst over in your view?
So, frankly, emotions play a major role in the stock market movements. And I don't think probably worst is over, but very difficult to take a call on the bottom of the market. But at the same time, history has shown that whenever there are large corrections, the market always recovers. Like typically, if I go back to 2003 to 2008, when the market went up 6.5 times, there were many such corrections, 10%, 15%. But the one which I think is very similar to what we have seen now, but it was much sharper. It was about 30% correction in May 2006, May, June 2006. And the reasons at that point in time the economy is slowing down, the prices have moved to ahead of fundamentals. At the same time, there is global uncertainty, and the market fell by 30%. In fact, the leaders at that point in time were typically most of the infrastructure stocks like ABB, Siemens, Larsen and Toubro, and many others, which fell anywhere between 25 to 40%. And but by that time, by 2006, the market had already reached 2.5 times from 2002 2003, and then it fell 30%, and people thought that it's all over. But from there, the market went up another 2.5 times to by 2008 January, it was nearly 6.5 times from the bottom. So I don't think this time it's different. It's the same. The companies are doing well. Maybe the growth has slowed down a little bit. Doesn't matter. The basic story of India is still intact, and this should be taken as an opportunity to buy.
This should be taken as an opportunity to buy, but buy where and what? This becomes more and more important right now, Milind, because for the last 3 or 4 years, it was as simple for a lot of newer investors that you throw the dart at the dartboard and you're hitting something. I think that phase might be behind us for a while. So when you are looking at allocations, what are the filters you are applying and where are you seeing value?
So I have always been saying that our focus is long-term growth. So wherever I see a huge opportunity, in the sense we have India, which is growing at about 11-12% nominal GDP growth. So any company or any sector which can grow at least 15 to 20% for a very long period of time. And when I say long period, I'm talking about anywhere between 5 to 10 years and beyond. You should be invested in those type of sectors or those type of companies.
Milind, good morning. Neeraj here. And can
Good
you
morning,
elaborate
Neeraj. How
when
are you?
Very, very well. Thank you so much. Lovely having you. Can you elaborate on that point? What are those kind of companies?
So you know me, Neeraj. It's
The themes.
predominantly consumption. But when I say consumption, I just wanted to once again repeat that
Thanks, etc.
whether it's banking and finance, whether it's retail, whether it's insurance, whether it's pharmaceuticals, whether it's hospitals, these all, according to me, fall under consumption because they benefit out of rising per capita income. So as such, consumption, according to me, should be about 70-75% of your portfolio. And then, of course, industrials, infrastructure, even wastewater management and things like that. Those also could be.
Yeah. So, Milind, let's try and bifurcate some of these because the last couple of days, the bit of a revival that we've seen in the last few days in the small cap space might have gotten people's spirits slightly up again, right? So, would love to understand this in a bit more detail. Yeah. Let's say the expensive consumption names, discretionary consumption, right? It could be the retailers, for example, in select cases, consumer durables.
I can't hear you.
Okay. Milind, can you hear me now? Okay, I think Tamanna, you want to try? Maybe he can hear you.
Milind, can you hear me? Okay, I think we seem to have lost that line. We'll try and get him back. But I thought it's interesting he's talking about consumption. But of course, in a broader bucket, I suppose, not typically, you're not talking about your FMCG or only your discretionary consumption.
Likely not. A lot under the sun. 70% of portfolio under consumption and so many triggers. Maybe ask him, Tamanna, that.
Yeah.
So, Milind, let's try and bifurcate this. Can you hear me now?
Yes, I can.
Okay, brilliant. So, Milind, let's try and bifurcate this now. Now, I'm first going to the first level or first order of consumption, and some of those names expensive. It could be retail, it could be consumer discretionary in some sense. It could be, if we classify EMS players, they're also catering to consumption, though they're manufacturing, but let's say in some sense consumption, right? So they are expensive, and we've seen in the case of Trent, in the case of Dixon, in the case of so many others, that a quarter of a shock coming in brings down the multiples quite significantly, right? So please take your time and tell us, how do you think about such times wherein some expensive names which have shown years and years of growth, EMS companies don't have 20-year history, but 4 or 5 years of very strong growth, for example, right? And a quarter of mismatch, etc., pulls the valuation multiples down. How do you go about thinking through these? And are you constructive on these buckets after this corrective move that we've seen?
So frankly, when Trent went up to 8,000, even I was perplexed as to why it went up to 8,000. And then it has corrected as well. Not only Trent, but many other stocks have corrected. But before that, I would like to give a disclosure that we do own Trent in our portfolio, and our fund, as well as personally, I own Trent in the portfolio. And this is not an advice or anything. It's just a discussion which we are doing. So coming back to these type of stocks. So when I say that we look at the companies with a long-term opportunity, you should look at it as a genuine long-term opportunity, and you should keep investing whenever there is a correction. When it comes to whether it's cheap or expensive. So if Trent grows, I'm giving again an example as Trent because you asked me so. So if Trent can go at 25-30% year on year for next 10 years, will not be the largest retailing company in the world. It will be much smaller. And despite that, so if you think that this is possible because Indian per capita GDP is likely to grow at about 15 to 20% uh, over a longer period of time, then you should be looking at these type of companies. Because I remember that between, I think, 2013 to 2017 or 10 to 16, I don't remember, when Trend did not go anywhere. Trend remained where it is. There were various reasons. Their store growth slowed down. So when we interacted with the companies, what they used to say then, and they even say now, that unless and until they get a good quality uh, retail space at a price which they think is beneficial to the company, only then they will grow. So whichever company is, even for that matter, Avenue Supermarket, they don't decide, they don't say that, okay, this year we will open 500 stores and we will be miserable if we open only 200. No, that's their aim or that's their goal. Whether it happens depends on a lot of other things. So these type of corrections, I think people can look at for investing in these type of companies. So I'm not worried why these companies came down, because I didn't know why these companies went up as well. So the focus has to be long term. The focus has to be the long term earning potential, and then you consider the PE after considering the long term growth potential.
Right.
If that you think is comfortable, you invest.
Got it. Milind, so just one follow-up here. What are ideal valuations for, and so by the way, I didn't ask you about Trent, but I just asked you about the broad bucket, but I'm glad you evoked that because it's a conversation point, right, with the store release numbers yesterday for Trent, etc. But just this whole retail space, right? Avenue Supermarts, Trent, both of them might trade at almost same valuation multiples currently. Growth rates are dramatically different, and both of them are high-quality franchisees. So how does an investor like you, for example, decide which to choose? And if you have chosen both as well, how do you decide where to allocate more? Because both of them are trading at the same multiples despite the difference in growth rates.
That's true. There are two aspects which I would like to bring to your notice. One of them is Trent is an apparel company, but it also has a grocery store in it. While as in case of Avenue, it only has grocery business. It also has apparel, but frankly, apparel as of now at least is not very significant. In India, the grocery market has a much larger opportunity than apparel. But at the same time, the first, let's say, discretionary buying happens in in apparel and not in grocery, because grocery you have many options, while as apparel you have there are certain brands which you like, and that is the reason why you go there. But over a long term, I think both have got equally large opportunities. So a 10-year view, I think, whether it's grocery, whether it's apparel, so anything which directly benefits out of rising per capita income. And here too, I would like to bring one more thing to your notice, that though we talk about large middle class in India, frankly, if you ask me, it's the 90% which are below, say, $5,000 per capita. These are the people which over a longer period of time will move to the higher level and will start benefit. The companies will start benefiting, because these consumers who are $5,000 and below will move higher, and that is where the maximum benefit can come in. So any company which is focusing on the lower end of the pyramid is likely to do much better than the companies which are there at the higher end. Incidentally, in case of Trend, they started all the verticals. So because of that, whether it's high end, middle end, and low end. So that is the reason. And grocery, where again, right now, because there is another debate which goes on between Zomato and Zomato and the old format stores. I think ultimately, it, the people who focus, or the companies who focus on the lower end of the pyramid, will benefit maximum.
Yeah, so, you've actually led beautifully to my next question, Milind, which is how excited are you about the platform companies and that quick commerce sort of movement? Because that's the hot story, and since you look at consumption so closely, are you as excited about it as the street seems to be, or do you think it's a bit overdone at this point?
I think even platform companies will do well. So they are into different segments, frankly, or they address different needs. For example, quick commerce. Why everyone is excited? Because all of us are sitting in cities with high population densities, and everyone is busy or thinks that he is busy, and that's the reason why he orders from a Zomato or a Swiggy, or these quick commerce companies. It's an habit which can stick on. But my view is that these companies will do well in those cities where the population density is high and where per capita income is high. To extend beyond that, it could be difficult for them. Whether this is a fad and will die down over a period, I don't know. Only time will tell. But regarding population density and high per capita income, if the population density is low, it doesn't work, because that is what has happened in the West. It has not. It has not worked. Quick commerce has not worked in the West. It's worked in India because of the high population density, especially in cities like Bombay, Delhi, Pune, and so on. So I am bullish on that. But if you ask me, these companies could do well for a 3-4 year period. Beyond that, I don't know. If this model succeeds and they are able to penetrate the smaller cities as well, they will continue to do well. But I think whether it's large format grocery stores or large format retail stores, it's possible that they may grow much longer than these guys.
Okay, so if I were to ask you, Milind, to look at uh, FMCG, consumer durables, retail, and then quick commerce as as the bucket of consumption, how would you rate them in terms of your most favorite to least favorite?
So retail is my most favorite.
Okay.
Uh, then comes platform companies. FMCG currently, we normally don't invest, because we have seen that, say, for example, in the United States, when organized retail just started. At that point in time, the top 5 companies in the US were FMCG companies. 20 years later, top 5 companies were all retailing companies, because the pattern of uh, control over prices moves from FMCG to retail. That's what happens. And that is also likely to happen in India. So in India, most of these large companies like FMCG companies, like whether it's HUL or, these are mature companies, and they are likely to grow at 8 to 10%. But beyond that, whether they will grow, I don't know. And since we focus on only those companies or those sectors which can grow higher than the nominal GDP growth, we would be underweight, or we may not own these companies.
Okay. Okay. Thank you so much, Milind. Pleasure as always speaking with you.